Bitcoin is down more than 25% from its recent peak. The fear and greed index is flashing extreme fear, and every influencer on the planet is screaming, buy the dip. But what if this is a trap? What if the data is hiding a secret that suggests this so-called dip might get a lot deeper before it gets better? While the crowd is looking for a quick V-shaped recovery, the smart money is quietly preparing for a painful 6 to 12 months of consolidation. In this video, I'm breaking down the critical warning signs the experts seem to be ignoring. Welcome back to the channel. Today, we're cutting through the noise. The popular story is that after a healthy correction from its all-time high of nearly $126,000 in October, Bitcoin is a coiled spring just waiting to bounce back. It's a simple, compelling narrative, and it could be dead wrong. Because if you look closer, a very different story is unfolding. A story told not by opinions, but by data. We're seeing conflicting signals everywhere. Institutional money is getting nervous. Key on-chain metrics are showing weakness. And the macroeconomic picture is far more restrictive than the bulls want you to believe. Today, we're going to dissect 3 key headwinds that could define Bitcoin's path for the next 6 to 12 months. First, we'll look at the institutional head fake, the surprising truth about recent ETF flows. Second, we'll dive into the on-chain data that shows the market's foundation is more fragile than the price tag suggests. And finally, we'll connect it to the big picture, the Federal Reserve's latest actions and what they really mean for assets like Bitcoin. By the end of this, you won't be surprised by what comes next. You'll be prepared. The biggest story of this cycle was supposed to be institutional adoption, led by the new spot Bitcoin ETFs. With assets under management swelling to a monumental figure of over $124 billion, this was meant to be a permanent floor for the price. And for a while, it worked. But the moment the market showed weakness, that story started to crack. Just look at the data from early December. We're seeing wild swings, with days of significant outflows followed by sudden inflows. For instance, on December 8th, spot Bitcoin ETFs posted a combined net outflow of over $60 million, driven by profit-taking and de-risking ahead of the year's end. This isn't the steady, unwavering institutional demand we were promised. This is nervous money, quick to pull back at the first sign of trouble. This erratic behavior suggests that big players aren't just diamond-handing through the volatility, they're actively managing their risk. What's really telling is how this money is moving. Even on days with overall outflows, BlackRock's IBIT fund often continues to see inflows, suggesting investors are rotating between different Bitcoin products rather than just cashing out entirely. This tells us that even the big players are getting defensive and repositioning, not just blindly doubling down. The most critical metric here is the psychological floor for these ETFs, which many analysts place around the $80,000 cost basis. Think of this as the break-even price for a huge chunk of institutional capital. With the price hovering around $90,000 as of mid-December, that buffer is uncomfortably thin. This isn't a launch pad, it's a precipice. The idea that institutions would provide a hard floor is being tested, and they could even become forced sellers if the market continues to weaken. The institutional safety net has become a source of risk that most people are completely ignoring. Now, let's go a layer deeper, onto the blockchain itself. This is where the story gets even more concerning. While a price near $90,000 might seem strong, several on-chain indicators are flashing warning signs typically seen in the early stages of a bear market. First, let's talk about network activity. An asset's value is driven by its network effect. When you see key metrics like network activity and trading volumes begin to decline, it signals shrinking participation and speculative interest. This is not the sign of a healthy, growing ecosystem ready for its next leg up. It's a sign of user fatigue and capital pulling back. Second, momentum indicators are failing to confirm a bullish reversal. Indicators like the Chaikin money flow have remained negative for much of the past month, showing that capital continues to flow out of the network even during small price bounces. We're also seeing that whenever the price tries to build momentum, it gets slapped down by sellers who seem to be using every bounce as an opportunity to exit. Finally, let's look at what the long-term holders are doing. While the price has been consolidating, analysis shows that unrealized losses have been climbing, putting these committed investors under more and more stress. One metric, the relative unrealized loss, has climbed to 4.4% after spending almost 2 years below 2%. This indicates a shift from market euphoria to stress and uncertainty. When even the most dedicated holders start feeling the pain, it raises the odds they could begin to sell, adding more pressure to an already fragile market. Taken together, these on-chain signals paint a picture of a market that is weak from the inside out. The foundation is shaky, and without a decisive rebound in network growth and buying pressure, the path of least resistance is likely lower. Now, before we get to our final and most important point, the macro headwind nobody is properly discussing, if you're getting value from this deep dive and want to stay ahead of the market with data-driven insights, not hype, do me a favor and hit that subscribe button. It's free, and it ensures you won't miss the next update. The final piece of this puzzle, and arguably the most important, is the macro environment. For the last couple of years, crypto has been dancing to the tune of the Federal Reserve, and the Fed just made a move that many are misinterpreting as wildly bullish. At their December 2025 meeting, the Fed cut interest rates for the third time this year, bringing the benchmark rate down to a range of 3.5% to 3.75%. On the surface, rate cuts are great for assets like Bitcoin. Lower rates mean cheaper money, which encourages investment in higher-risk assets. However, the devil is in the details. This was not a dovish, all-clear signal. It was what many are calling a hawkish cut. The committee was deeply divided, with 3 members dissenting from the decision. More importantly, the Fed's own projections signal only one additional rate cut for all of 2026. The market was hoping for an aggressive easing cycle, but it got a hesitant Fed that is still worried about inflation. This creates a restrictive environment for Bitcoin. The easy money conditions that fueled previous bull runs are not coming back anytime soon. Instead, Bitcoin has to compete for capital with assets like US Treasuries, which are now offering a respectable, risk-free yield. In a world of higher-for-longer real yields, a non-yielding asset like Bitcoin becomes a much harder sell for large-scale investors. The market's negative reaction, with Bitcoin dipping below 90,000 right after the announcement, tells you everything you need to know. The macro tailwinds everyone was counting on have stalled. So, what does this all mean for the next 6 to 12 months? When you put the pieces together, the picture becomes clearer. We have institutional players showing caution, we have on-chain metrics demonstrating a fundamental weakness in network health, and we have a macroeconomic backdrop led by a hesitant Federal Reserve that is no longer providing the fuel for a speculative rally. This doesn't mean the long-term Bitcoin thesis is broken, but it does mean the path forward is not a straight line up. The data suggests we are entering a prolonged period of consolidation. While some long-term forecasts remain incredibly bullish, the most likely scenario for the next 6 to 12 months is a choppy sideways market, likely trading in a wide range between a support zone of $70,000 to $75,000 and a resistance cap around $110,000. A break below that key support could open the door to a much deeper correction. While the rest of the market is looking at this dip and seeing a bargain, the data is telling us to see a warning. This isn't the time for blind optimism. It's the time for patience, for strategy, and for paying attention to what the data is telling you, not what you want it to say. Be prepared, not surprised.